SRM Tech Talks. We do this every other week. We bring together experts from the fintech space, banking space, credit union space together with the purpose of kind of forwarding the benefits to all of those ecosystems. Today we have Robert Morgan. He is the CEO of USDF Foundation, and I'll let him talk about what that is. But in short, they're doing tokenized deposits on blockchain. They've got a number of participating banks. This is something that could be open to probably banks as well as credit unions. I think some of your original founders were Synovus Bank, First Bank, New York Community Bank, as well as some others. I mentioned in the invite, Rob was actually busy last week testifying to Congress, which he did a great job at. So kudos to you for representing the industry. With that, I'll turn it over to you. We've got about 50 minutes to talk or present. If you want to share slides, you're welcome to do that. If you want to have a conversation, you're welcome to do that. And then we'll generally hold about 10 minutes at the end. People are welcome to put in the comments, questions. I will monitor that as well. And at the end, we'll make sure those questions get asked and people will be able to ask you those directly. So with that, I'll turn it over to you, Rob, and thank you very much. I appreciate meeting you last 2 weeks ago or 3 weeks ago at Tennessee Bankers meeting as well.
Larry, thank you for the opportunity to join you today. Thank you for the kind introduction. Really great to be here with you all. I will start off, just give a brief overview of USDF, myself, where this fits in. I have some slides that I can go through as well to talk about where we're implementing what we're doing, add a little meat on the bones. But this is always better as a discussion. So I'll stop periodically, take the slides down, see if anyone has questions. I would much rather have a conversation than talk at you through some slides. So Larry, you gave a better version of my resume than I would. Really, but one of the things I think is important, I joined the consortium about a little under a year ago. I moved from ABA, where I spent the past 12 years building and running their Office of Innovation, and really did so because I think this is a critical question for the future of community financial institutions, both banks and credit unions. And really sort of two main theories here. The first is the important role that we think blockchain technology, not crypto, blockchain, can play in powering the future of financial services. And two, the recognition that the way we are going about it today is all wrong, and that we're not capturing the real world value. And so let me give just a minute on both before I dive into the who we are, what we are, official pitch. The first is on blockchain. And I get frustrated with this pretty regularly. Blockchain is often pitched as this silver bullet that's going to solve all of the world's problems. And I take issue with that. It's not. Like any other technology. It has its strengths, it has its weaknesses. But this is a unique technology that brings a lot to the table. And I think if banks and credit unions aren't allowed to play in this space, particularly community institutions, we're going to see them at a disadvantage going forward. A couple of things that blockchain does that's unique. One is it can break down silos, both within institutions, between institutions, and between asset classes. So the ability to leverage a shared ledger means I'm not looking at my core system, reading out what my screen says, and talking to someone else who's reading from another core system. We're all operating off the same shared Excel spreadsheet. And that lets us do a couple of things. First, we think it helps effectuate faster, cheaper payments. That can help both, help people get real-time access to funds, things like payroll, as well as help small businesses receive payments more quickly, have better access to funding. The second thing it adds above and beyond other payment system modernizations like RTP or FedNow is the programmable nature of blockchain. So blockchain is unique in that you can have programmable transactions that execute based on certain real world conditions. So an example of this is something as simple as funding a mortgage. Today, you send a lot of money to escrow. That escrow agent spends the next day calling and confirming wires to the 5 or 6 different parties who participate in that transaction, real estate agent, title agent, et cetera. what we can do with a smart contract and with smart payments is automatically route those payments when there's wet ink on a page, route those payments to the right party in the right amount at the right time. It can speed up the process, it can add transparency for customers, and reduce the risk of fraud, right? The ability to insert a fraudulent wire address, for example, through email compromise. The third piece, and I think this is where blockchain gets particularly exciting, is when it is used as a system of record, not just for payments, but for traditional banking assets. And by that, I mean, what happens when you record a loan on the same system of record as a payment? It makes it really easy to buy and sell loans or other traditional banking assets between institutions. And so we think that can help both reduce the barrier to adopting new technology. It can create a more open platform that allows smaller institutions to leverage the same tech platform as some of the largest. We also think it can create marketplaces for things like loans in categories that are less liquid today, lowering funding costs, giving banks and credit unions more options in the space. So that's one, right? The potential of blockchain, that's where we really see blockchain moving the needle. Two, and this gets to why we were up talking to Congress last week, is we don't like how it's been done so far. In particular, what we've seen is a number of really volatile assets building products that sit in their own sandbox. Really interesting proof of concept for the technology, but not driving real world value. At the end of the day, if financial services are going to add real value, they have to help move real world economic activity, help people buy a home, help a small business hire employees, buy capital goods. Crypto has not executed on that today. It is an ecosystem where you've got all of these interesting financial products designed to help you buy more crypto and make more and more leveraged investments, not creating real world value. To do that, you need something that looks like a dollar that exists natively on blockchain. This is what led to the rise of stablecoins, and it's what's driven the policy dialogue around the creation of a central bank digital currency. How do we use blockchain for some of these real world applications? And it sort of started off this format war for the future of money, right? What format will our money take over the next 20, 30, 50 years? And what it ignores is that the way money exists in our economy today is already largely digital and primarily exists as insured deposits. 73% of money in our economy today is an insured, well, not all of it insured, but is a deposit of an insured depository institution. And there are a lot of reasons for that. We think that's a really important instrument, both for the institutions that rely on them, folks on the call, but also for the communities and the customers that you serve. It powers your ability to provide credit into those communities, and moving to a stablecoin or to a CBDC takes money off bank and credit union balance sheets where it can be lent back into the community and moves it either to a stablecoin issuer who's going to have to put it all into some safe asset that they can't create. They can't create credit the same way that financial institutions today can, or it's going to go to the Fed, where again, they can't put that money back into the economy. So I thought it was just crazy that we had this world where you're reconsidering the form, the market structure for money just to implement a new technology. And so what we're doing with USDF, started with 9 banks, we've added a few more since. No credit unions yet, but credit unions are welcome. These are a group of banks who have come together to build out blockchain infrastructure for traditional banking services, no connectivity to crypto. By representing an existing deposit on blockchain, we allow for the creation of a blockchain native payment rail that can facilitate money movement between those institutions with all of those benefits we just talked through. So there's a lot there. Again, I have some slides that go deeper into this, but why don't I just stop, see if there are any questions at the start.
And you might have to unmute yourself because I muted everyone. One question I had, and I think you've already obviously addressed it, I just want to highlight it, is, there's some pros and cons between, say, tokenized deposits and stable coins and central bank digital currencies. As I see it, tokenized deposits would be certainly domestic only. Obviously, so would be central bank digital currency. At some point would probably be used for international stable coins could be used internationally. You make a great point, though, with both central bank digital currencies and stable coins, in that a central bank digital currency really wouldn't have any liabilities associated with it. Stable coins being required, at least our expectation is Congress will require those to be backed 100% by US dollars or treasuries or something like that. Both of those tie up liquidity from the system, and both of those could pull liquidity from the system in the event of financial stress, right? Because the could move to the perceived safer solution than the traditional banking system, which is fractional reserve banking system. Whether you think that's a good thing or bad thing, I think from an economic standpoint, from a government standpoint, from a treasury standpoint, that's probably a bad thing. The benefit of that tokenized deposit is you could rehypothecate it. It's just provided as an electronic version, and that ability to utilize that electronic version for automating processes, because it is a digital form of money and it's a programmable form of money, provides some real benefits. Is that all fairly accurate? Is there anything else you would want to point out as pluses and minuses there? The only really plus I see of a stable coin, actually maybe two of them. I think your solution, at least initially, is going to be kind of for interbank transfers, maybe corporate solutions, not necessarily a retail solution. I see stable coins as potentially offering a retail solution. I also see stable coins as being something that can be used internationally for transactions. Now that could be both a bug, a flaw in the feature, right? Because of not knowing who the counterparties are, who you're dealing with. It could be dealing with a sanctioned country, those sorts of things. So is there anything else you'd want to add there, or maybe clarification?
Yeah, it's a really important point, and I tend to agree with your sort of strengths and weaknesses with each bucket. I'd say on the stablecoin side, right, they can facilitate access to that non-bank crypto ecosystem. Again, whether that's good or bad in your view depends on your view of crypto. That's not what we're looking to do. Tokenized deposits within banks and credit unions look a lot more like a payment rail. Funds don't sit in wallets; they settle into traditional accounts. And the bank operates the payment rail for the customer the same way they would with a wire transaction. We just think it's an upgraded back-end technology. The international component's another interesting one. We think there are opportunities there. But at the end of the day, the frictions in international payments have very little to do with technology and more reconciling different legal structures, different AML, KYC requirements. And so one of the other distinction I would make as a broad point is, as we look across the space, yes, the ability to use deposits to fund loans, critically important, right? We've made that point. The second is, how do you maintain the careful balance between the need to maintain privacy and the need to enforce AML, BSA, counterterrorism financing requirements? And I think if you look at stablecoins, they fall on one end of the spectrum, right? There's a lot of privacy, but you don't know who's holding a stablecoin, right? It exists in an unknown wallet. The stablecoin providers will tell you that they do lots of AML, KYC work when they give it to you, but then I can just go move it to another wallet, right? And I've been in the room where a bank made the comment that that's not all that different than operating Swiss numbered accounts. Can we go back to that if they can continue doing this, right? On the other end of the spectrum, you have a CBDC where individuals are creating a more direct relationship with the federal government. And again, depending on your position, that can be good, that can be bad, but clearly tips the scales in terms of what the government can see about individual transactions and changes. We think that deposits maintain the really careful balance. And again, there's a lot of criticism of where that balance is today, but it doesn't second guess that balance between privacy and the ability to enforce financial crimes. It maintains the two-tier banking system that creates that separation today. So that's another piece I think that's really important here.
And your platform is on its Providence blockchain, which is a permission blockchain with X number of nodes, as opposed to a permissionless blockchain where there's not a lot of controls to who uses that. I guess from a privacy standpoint, I challenge you and I'd agree with you. From a stablecoin standpoint, you're right. I mean, You don't know who's using it, but obviously with blockchain analytics, you could be found out. In a banking setting, you want to know who's using it from a know your customer or know your transaction standpoint, but you don't want the rest of the world knowing that Larry has X number of dollars and is doing certain transactions. So I think your solution really addresses that, in that it's privacy from a bank standpoint, but it's not privacy from a who are you standpoint. It's a, we know who you are. You know, you're not a sanctioned individual, you're not prohibited individual, as opposed to stable coins, which could be anybody, right?
That's right. So, at the end of the day, it's no different than a bank sending a credit union a payment via FedWire or ACH. There are certain fields that need to be disclosed as part of that. All of the same rules apply regardless of the technology that is used to facilitate it. This maintains those rules that are in place today.
Now, does FedWire become a competitor for you, or is that complementary for what you guys are doing?
So we think FedWire and even the implementation of FedNow is really complementary. The line I use here is, I wouldn't be doing what I'm doing if I were trying to outfed the Fed. There's a lot of work being done on payments modernization. We think that can help facilitate faster, cheaper payments. But we also think blockchain adds value above and beyond that. By bringing those payments on chain, we can leverage things like FedNow. And we think that FedNow might plug into the back end to help reduce bank-to-bank liabilities, while maintaining the ability to use blockchain to move payments and information at the same time and on the same database.
Rob, I'd love to hear some use cases, and I know you've got some. What I would love to, though, is first, let's see if anyone else has questions, because I have a tendency to monopolize conversations.
Please.
So go ahead and take yours off mute, and anyone just jump in.
And I see a comment in the chat, same with the clearinghouse. Okay. Absolutely, right. I think the wholesale payments infrastructure, whether it's RTP, FedNow, we believe that is all complementary to what we're building. We think blockchain-based rails help bring those to market, bring those to the end customer in a way that adds that programmability, allows for blockchain to be the system of record to start. In many ways, we're more competitive with cores than we are with other sort of wholesale payments infrastructure. That allows you to start using blockchain as the system of record for those things.
That's a great question, correction. Other questions? All right. Well, Rob, we'll maybe move on to discussing some use cases, or however you want to take the presentation so far. This has been really enlightening.
Perfect. So what I'll do is skip through the first sort of third of the presentation here, because I think we've covered it better than we would have with slides. But I'll walk through just quickly what a USDF transaction looks like, what we're seeing some of the largest institutions do, and then talk about some of the specific use cases. I'll continue to stop and would love questions as we get them. So let me see. Hold on, see if I can share just my screen. Give me 1 second. I have an issue with the share. All right. Looks like I need to share the whole screen. Is that coming through okay?
Yep, looks like a lovely picture of maybe Maui or Hawaii. Where would that be?
Oh, you're not getting the slides. Okay. I had full screened those on my end. Let's see.
Take your time. We usually go through this a few times with most of our presenters, ourselves included.
Yeah, I'm used to Zoom. Can you see the PowerPoint deck now?
Not yet.
All right. It looks like it's only showing my backdrop and not my slides. So what I'm going to do is just go without slides, and happy to share a version of the presentation after this. It's probably just as easy to talk through some of these.
Rob, if you want to, the other options, you could email it to me. I can pull it up for you. It's entirely up to you.
That's right. Nothing critical here. Always good to have visuals, but we can circulate these after the fact. What I would say, first, the way a USDF transaction works, I'll give the very brief version. A bank or credit union will have a customer who instructs them to make a payment on their behalf. That bank will debit that customer's account, move the money to an omnibus account. They will then mint a tokenized deposit against that in the bank's wallet on chain. They will then transfer ownership of that tokenized deposit over to the other bank or credit union, who will then in real time credit the customer's account, create a receivable in an omnibus. And at the end of the day, the chain will record the net of all of those transactions, both between those two institutions and the rest of the network. Will create a net settlement report. All of those institutions will settle via Fedwire at the end of the day. So for customers, really feels like a traditional payment rail, but hopefully that helps think about exactly how this fits into the flow.
Hey,
we think that. Go ahead, please.
So, hey, Rob, sorry, Prakash here. Just so it is happening only at transaction time, is it? The conversion of thing into your blockchain, is it a transaction level protocol, or is it like the asset themselves are held in the blockchain and then moved?
So the blockchain transaction happens in real time for each transaction. At the end of the day, the way those banks settle up in Fed money is through a netting process that the consortium operates, and that netting happens, and the settlement for that net happens via Fedwire. That answer the question?
Yeah, so the backend still is happening on the traditional wires. So the conversion of fiat to crypto or USDF on this provenance blockchain happens during what time of the interaction though?
So that all happens in real time. And think about this, the same way sort of Visa and MasterCard for retail payments calculate and transfer liabilities in real time. That's what we're using the blockchain to do. So the blockchain effectively records a liability from bank A to credit union B in real time. It nets those out at the end of the day. So the same way, a Zelle transaction, for example, appears real time to a customer, and then the bank settle at end of day. This works much the same way.
Got it. Okay, super. Thank you.
We do think over time, and depending on the use case. So for small transactions, we think that makes a lot of sense to maintain that model long term. Because there's a lot of economic benefit to netting out those transactions. You only have to run one smaller wire at the end of the day. But if there are certain large dollar use cases, it may make sense to eliminate those in real time, right? Eliminate those liabilities. This is where we think something like a FedNow or an RTP fits in. And I think that will depend on individual bank risk profiles. It will depend on different use cases. And so I think we'll see a mix between those as we move forward here.
So Rob,
because sorry, go ahead. So the final
ahead.
settlement rules are still based on the established rail. I mean, either it's chips or Fedwire, or they have limits on transactions. So the end would still be based on those limits, but then the technology for multi-partite settlement is facilitated using this protocol that makes it much more easier for everybody. That's kind of the value prop.
That's right.
Got it.
So the client is effectively real time. Given that there is that use of the omnibus account and settlement between institutions happen, let's say end of day, is there an opportunity to reverse the transaction? So like normally in blockchain world, right, those transactions are settled, there's finality to it. And there's going to be finality to FedNow when that happens as well. In your particular solution, I would imagine there is some period of time where a transaction could be reversed if made in error. Is that a fair assumption?
Yeah, so there are network rules that deal with all of that, and sort of this is not sort of decentralized land where what happens on chain is the final arbiter of all truth. And even if you have a valid claim that go yell at the blockchain, it's not like that. There's a series of network rules that govern exactly when those payments are final. I'm happy to go into more detail on exactly what those are, but they do look, very similar to real-time gross settlement rules today. So there is finality in real time. We think that's really important. You want that transaction. If you're releasing goods, for example, you want to know that's not going to be clawed back. And so there are, the appropriate dispute mechanisms built in, et cetera. But you do want real-time finality and certainty of that payment so that you can do all of those other business pieces that rely on the payment in real time as well.
So essentially, it is a final settlement, more or less.
It is. Yes, that's right.
Cool. And from a cost standpoint, what does this look like? So I mean, obviously, we're going to have FedNow, and the implementation costs aside, I think a transaction cost, and I could be totally wrong on this, but I thought it was like 4.5 cents, which is dirt cheap. What does it cost? Like, what are the costs involved? Is it a functionality benefit? Is it a cost reduction benefit that you provide? Maybe talk a little bit about that.
Yeah, absolutely. So we do think there's a cost benefit. But like I said at the start, if we were just trying to outfed the Fed here, we wouldn't be doing what we're doing, right? 4.5 cents a transaction, that is cheap until you start getting into small dollar transactions, things like micropayments, et cetera. By netting those transactions throughout the day, we do think there's cost savings on those transactions, particularly when you look at B2B use cases that are primarily done via paper today, right? The costs associated with those are much higher, the costs of sort of large wires, et cetera. So we do think there are cost efficiencies here, but what really makes it exciting, and this may be a good opportunity to jump into some of the use cases, is where we think blockchain has added functionality, where that programmable nature is really important. That's not something we see in those other platforms. And where we start thinking of blockchain as the system of record for other traditional banking assets and liabilities. That really facilitates the use of blockchain as the system of record for more than just payments. And the last piece I'll sort of leave with, and then I'll jump into some of the use cases that our members are thinking about. And I think this is something that's important, particularly for this group. I really do believe blockchain can help level the playing field between large and small institutions. It sounds like a line, but I think it's true, right? What we've seen in the past is, and in the recent years, a lot of industry consolidation has been driven by this move to technology, where companies with large customer bases, large depositor bases, can spread big tech investments over a broad base, right? JP Morgan can make investments in everything because the amount per customer that costs is tiny. As shared infrastructure, blockchain sort of flips that on its head because now there's one piece of infrastructure that the industry is leveraging as a shared resource. Now it'll take us a little time to get there, but what that does is it changes the key metric from number of customers to value per customer. And how much value is your institution adding? How much value is your relationship adding? So really optimistic about that. And one of the things I'm passionate about with USDF is we see USDF, because we're owned by our member banks, we're not selling a tech product. We see USDF as a platform to ensure banks and credit unions of all size have a seat at the table, particularly as we see some of the largest institutions invest in this technology. You're going to see at the end of the month, a group of 10 large banks led by Citi, Wells Fargo, and even the New York Fed are running a pilot on tokenized deposits, right? We think that USDF is consistent with that and is a way for banks of all sizes to participate. Similarly, JP Morgan has rolled out JPM coin because they need these efficiencies to move money within their own four walls. Now their four walls are big enough where that makes sense. But again, we think that as industry standards converge, we want to be the table that gives everyone a seat and a say in how that's developed.
So Rob, if I'm a bank or a credit union, I've got corporate clients and they're doing business on weekends or in the evening or whatever, that ability to settle that transaction instantly, that's a big selling point, isn't it?
It is, right? Think about when would you send a wire today? And if you have a customer that wants to send a wire at a certain hour and misses that window, that having this 24/7 real-time payment rail creates real value, we think, to those customers. Now you've got to have the right controls with that, but that goes without saying.
And how is liquidity managed here under those scenarios? The banks would have to cough up more money, convert into digital assets, and shore up their balances, right?
Yes, effectively. So the banks move that money to the omnibus account. That is what sort of guarantees that that's the asset that is held against the minting of the tokenized deposit.
Got it. Okay.
And so, as we think, it may be helpful to talk about use cases. I find, the idea of blockchain-based payment rails is interesting, but it's harder to think about how it drives business value at the end of the day. So I thought it might be useful to share a couple of use cases where our members are thinking, how can blockchain help improve a process, and where does it make a difference for my institution? We tend to think of these in three categories. We have sort of the near-term bucket, medium-term, and long-term. In the near term, we're really focused on solutions. We have 9 banks today who are at the pointy end of the spear, working on implementing USDF payment rails. How do we create value in a network that has 9 banks, right? There are a number of applications we think create value even before we go sort of nationwide. The second phase is looking at applications that create value once we have a broader network of banks online, once it's interoperability, once the large banks get moving with their own tokenized deposit initiatives, for example. And then long term, which actually may happen before medium term, but what happens when you have broad adoption of blockchain, not just for payments, but for recording other traditional assets like loans, mortgages, even treasuries, for example. The ability to use blockchain as a system of record for those. So I'll start sort of in that order. I'll talk about a few in the near term that we're looking at and sort of work to that longer term vision where I think we get more and more of the value of blockchain. So in the near term, a lot of it's focused on that programmability. One area where we've seen a lot of interest, we had actually started working on this prior to some of the failures over the recent months, is reciprocal deposits. So we think there's an opportunity to use blockchain-based payment rails to allow for transactions between institutions, so a small network of, say 9 institutions, to allow customers to spread deposits across, maximize deposit insurance. Obviously, that exists in a number of forms in sort of well-recognized business models. We think blockchain adds value above and beyond these for a few reasons, and this is where that programmability comes in. So the ability to have real-time access to those funds. If you look at insured cash sweep products today, typically you have to move funds over a day or so before to have certainty. So, say I'm a business that has payroll on a Friday, I don't necessarily want a large uninsured balance sitting in that account from Thursday to Friday, right? We've seen examples in the recent past where that would have been an issue. So what this allows for is, and one of the reasons why that doesn't happen in real time, each institution has individual relationships and money comes out of different banks or credit unions depending on the individual relationships and contracts that they have. We can program that all into smart contracts. That means, for 1 minute before the ACH file for payroll goes out, we can draw down those funds across the network of banks that are holding deposits. That's one area we think there's significant value in the near term. The other that I think is particularly interesting is in loan participations, right? As smaller institutions try to make loans, maintain relationships with a growing customer who may be, growing to their credit limits, that institution wants to maintain the customer, maintain the relationship, but can't make the loan. So we'll let other banks or credit unions participate in that loan. Today, this is generally done via Excel spreadsheet. But we think there's an opportunity to automate the payment flow from that borrower all the way through to the participating banks. So rather than a borrower paying Bank A, who then calls up the CFO at Bank B, Credit Union C, and says, here's the payment, here's the percentage. You can automate that flow based on the terms of the contract to flow all the way through in real time to the banks that are participating in those transactions or in those loans. That's another we think is exciting. Third area our members are focused in the near term is on B2B transactions. Now, this is one where for some transactions, you really do need the whole industry on a payment rail. But there are certain industries where things like supply chain management, right, where you have a number of vendors at the same institution or at a network of institutions. we think this can add transparency and lower costs for a number of those transactions. This is where that real-time nature becomes really important. Similarly, invoicing is another area our members are looking at. With invoicing, that programmability adds some interesting features. You could, for example, have the terms of an invoice captured in the payments. So, if something is 30, 60, 90 days, you add a certain premium to the payment. You can automate all of those processes as well.
Hey, Rob,
So,
is there an opportunity, because I just think about like international transfers and correspondence banking and trade finance, is there an opportunity for this to be leveraged in a trade finance situation?
So there's a ton of opportunity for trade finance. What I would say is the barriers get a lot higher once you start moving money internationally. I think there's a lot of opportunity to use blockchain to improve those flows. We're focused on domestic payments today. And if you look at the Fed's report on CBDC, even in sort of advocating for where CBDC can make a difference, they recognize the hurdles in international payments are rarely it's a technology issue. Often it is market structure, legal structure, and reconciling between two different countries. So we think at some point this can add a lot of value there. The New York Fed just completed a study with the Monetary Authority of Singapore on this. I think it's Project Cedar. It's worth looking into. I think there's opportunity there, but there's a lot to sort out. And I'm seeing a comment on the impact on deposit insurance. Happy to take that. I think one, it's not clear today exactly how tokenized deposits will be treated, whether they are insurable or uninsurable. The FDIC has a proposed rule out on signage, which obviously covers a lot of ground. How do you advertise deposit insurance? One of the things it does is takes what we think is a bad stance on the application of blockchain to deposits. We've submitted comments to the FDIC. Our hope is that they revisit this. But in the proposed rule, they define anything recorded on a distributed ledger would be counted as would not be an insurable deposit, and you'd have to provide all of the disclaimers associated with assets that can gain and lose value, et cetera. We think that creates a ton of confusion, and we think that long term, it's not clear exactly how much should be insured versus uninsured. But the FDIC at some point needs to have an open dialogue with industry about how and when deposits recorded on chain can be insured. Our position is that the system of record, if I'm using a cloud-based core versus an on-premise server, that shouldn't change the nature of my deposits. Neither should blockchain. But understand that there isn't clarity today. For our current model, we don't think there's a big impact because, again, funds settle into traditional accounts. Does that answer the question?
That's a yes.
The one piece I might add is sort of the ongoing debate around deposit insurance limits. We do think that this reciprocal deposit model can help answer some of those questions. So if you look at the FDIC's recommendations for extending deposit insurance, right, they've not recommended unlimited insurance for everyone. I know there are a number of folks in industry that have the same concerns about that. What they've looked at is business transactions accounts because a payroll file might exceed 250,000. And we think this can help address that by facilitating real-time access through those reciprocal deposit networks.
Yeah, and I've heard the idea around kind of tiered insurance based on deposit size, which I think would make an awful lot of sense.
Yeah, absolutely. And so, at the end of the day, we think this could even mitigate the need for that point in time insurance where someone might have to carry a large balance to pay a payroll file. You can really limit the time by providing real-time, transparent access to this. Our hope is that limits the need for additional insurance as well. Great. Other questions? I'm happy to take a few minutes and talk about some longer term use cases, but want to make sure we've answered all of the near term questions here. So let me talk a little bit about some of the medium term use cases. This is where you get new use cases for things like retail payments that really aren't possible today. Things like embedded payments, those are possible to some degree. How do you, that's one that's exciting for me. How as a bank or credit union do you facilitate a more sticky relationship with your customer, particularly business customers, right? We saw a lot of business deposits were more likely to move than a lot of folks assumed. By being able to embed payment flows into a customer's website, for example, we think that creates stickier long-term relationships, creates more value for customers. It's one thing if moving banks means wiring money from bank A to bank B. It's another if I have to totally redesign my website. And so we think embedded payments are one that's particularly interesting. Micropayments is another really interesting one. Say if I read the newspaper in the morning, I open up the Financial Times, and instead of paying a monthly subscription fee of $10, $15, I get charged per article in real time as I read, right? You just sort of auto deduct certain payments. Or one that's particularly interesting, we have a member that's based in Nashville, and so we've done a lot of thinking about the music community and how do artists get paid for their music. You could have a system where concert tickets, those sales, a portion of those sales immediately go to the artist. You don't wait until after a certain period of time, do the accounting, and then deduct. You can have real payment flows, or even fractions of a penny every time a song is streamed on Spotify. So there's some really interesting things you can do in that space. The last thing I'll leave you with here is where we think blockchain makes a really big difference long-term is as that system of record, not just for payments, which is most of what we've been talking about today, but other traditional banking assets. And the simplest example is something like a treasury, right? So today, if I am a corporate customer managing a treasury account, and I want to move funds out of deposits and into treasuries, you still have a settlement period between those. You don't always have transparency into what has settled when. But by breaking down, so today, if I want to buy a loan, say, Larry from your bank, I would have to send funds to escrow, confirm that that asset is moved in a separate system of record, and then release the funds. What we're able to do by using blockchain as the system of record for both is in real time with no settlement risk. I can trade my dollars for your loan, and it happens in the same block. So the transaction will always go through. One party isn't left, holding the bag. You don't need all of the same infrastructure to manage those types of transactions. So down the road, we think that creates huge opportunities to facilitate more liquidity, allow for marketplaces to develop that can lower funding costs, help open up new funding sources, particularly for community institutions. So really excited about that. That's probably a little bit farther down the road, but that's where we think this is all going.
Rob, is
Rob,
there go ahead.
On the previous use case about all these micropayments and paying artists and so forth, what would those artists need to be? How do you see the ecosystem evolve for them to be able to accept payments on that use case? Do they have to be banking with one of those member banks, or what needs to be in place, and how are you preparing for it?
So there are some ways you could do this in the near term. I think there are near-term answers where you could do it with a small network, and there are long-term answers where you really need ubiquity. It needs to be everywhere you want to be before it makes sense, right? In the near term, something as simple as the contract between a distribution company, whether it's Ticketmaster or whoever else, and all you need is the artist to be on the same platform with the same institution as that customer, right? So you could say it was Spotify, right? Spotify streams a song, they transfer a fraction of a penny into an artist's account in real time as every song is streamed or every ticket is sold. So you could see a world where, yes, if that artist banked somewhere else, they probably wouldn't be able to access that, but where you're creating enough value that you might start bringing customers into your bank by offering this. So, if I'm a musician that needs liquidity, and there are a lot of those, being able to get my ticket sales in real time might be enough to convince me to open an account at a different bank.
Interesting. Yep.
Rob, one of the things that I believe FedNow can do, a number of other payment systems, is put through a request for payment. Is that something that's possible with USDF?
It is, and it's one of the values we think in blockchain is that it brings the data alongside the transaction, and so the form most payments are push payments in this model. Really, all of the payments are push payments. But what you can do is effectively it's an invoicing system where I send you an invoice if I want to request the payment. I send you the invoice that creates the payments instructions from your bank to mine. It gives you all the appropriate approval steps, and then it can again sort of tie the details of that invoice, record those on chain as well. So you have both the data associated with that invoice moving along with the payment, and there's no reconciling between those two systems of record. Oh, we saw a payment for $3,000 come in. That must be invoice number 231. Let's on the back end connect those. It means they all move in real time and together because of that.
And from a competitive standpoint, who would you see as competitors to your solution out there, and how would you differentiate yourself from them?
Yeah, so it certainly are companies out competing in the marketplace. JPM with JPM Coin is probably the biggest example. We think what the largest institutions are doing here probably has the most impact for everyone else. But as I said at the top, because we are owned by a group of member institutions, our interest is how do we get our banks to the right place, right? So we're more focused on interoperability. I know JP Morgan is never going to sign on to our payment rails. They're going to want to own their own. But how do we create interoperable standards that brings everyone along? So I think what some of those large institutions are doing in this space, the RLN tests, are really interesting. I think it's important that institutions of all sizes have a seat at that table. That to me is, I think, the biggest sort of competitive angle. Certainly other blockchain infrastructure providers, but at the end of the day, we're not selling a technology solution. The analogy I use is what we're creating looks a lot more like the ABA routing number for how banks communicate on chain than it does selling a technology product.
Awesome.
And to that end, I do think that the ability for everyone to participate, that's something critically important here. One of the first things we rolled out when I joined the consortium was a new membership model, right? So originally USDF was designed for the institutions that wanted to go implement payments tomorrow. We've rolled out a new tier to allow more institutions to access this knowledge base, participate in the working groups, committees, both that drive the public policy dialogue, but importantly, sit in as we develop those use cases and have that seat at the table. It looks a lot more like a trade association membership. It starts at $2,000 as opposed to big technology project. And so we think that's a way that can make this more accessible for banks and credit unions. So if you're interested in that, the goal of today was not to be a sales pitch, but we'd love to, we really do want to be that seat at the table for industry, whether it's USDF, whether it's other technology down the road. I think the ability of everyone to have a seat at this table is going to be really important to the health of the industry going forward.
Great point. And don't see that as a sales pitch at all. It was one of the things that I was going to ask about. So that's awesome. Seems like a very reasonable amount.
Yes, I think it's a fairly important question to ask, right? Because at the end of the day, I think you're creating this framework and this consortium to meet specific gaps. And I think you see it as a gap of the smaller institutions not having a common financial exchange mechanism. When you look at the clearinghouse and others being owned by some of those large banks, they have this kind of upper hand. How can we even the playing field with an alternate that blockchain is enabling? But I guess a lot of questions around, custodialship, your security, your breakage, and the provenance chain is a chain. Is it another chain, right? I think it's an interesting choice given how Figure has trying to use it for different banking use cases just a couple of years ago. So I'd just very, very curious on, if a credit union or bank comes to us and we talk about this, how would you kind of address some of those? Like membership is the easy part, right? Hey, $2,000, get on, participate. But like, how would you address some of those security? Like a whatever Mount Knox, whatever that all this hacking that happens and suddenly things disappear. It seems to be a case, and How do you go about addressing some of those questions, Rob?
Yeah, happy to take those sort of in order. First, I think on the use cases we see developing, I think there are a lot of banks and credit unions that saw the experience with Zelle and felt like the largest institutions moved ahead. And then 2 years later, they were offered as product that was too expensive after the fact, never really had a say. And we're sort of pressured to say, if you don't offer this, you're not going to be competitive. And so pay up, right? This is why we think that seat at the table is important here. As we see the largest institutions develop use cases, they look much more sort of financial market focused than retail banking focused. And so this is why we think having a place for industry to convene to address the pain points that community institutions have, that piece is critically important. So that's answer number one. Two, on the security and on the infrastructure question, one, blockchain itself has proven to be relatively robust. Even the public permissionless chains, despite, there are a lot of attack vectors, right? We are not on the public permissionless version of Provenance. We are in a private permission version where we serve as the gatekeeper, where only insured depository institutions can engage, and there are trusted vendors doing that validation work. You're not relying on this network of incentives to keep the system running. The idea is to have contracts in place with traditional banking vendors so you can hold the performance, right? This looks a lot more like traditional banking infrastructure from that perspective. That's critically important. We also see USDF really, I mentioned the sort of routing number analogy. We imagine USDF will operate on multiple chains going forward, right? So there's not going to be, in my view, one chain to rule them all. There'll be a number of different chains developed, right? Goldman Sachs has developed a chain for debt trading, right? There will be a number of different chains developed for different applications. We view USDF as being critical to allow for transactions in a number of different applications, right? One may be a mortgage database. Another may be loan participations. Another may be related to deposit sweep networks, right? So there are a number of different ways. It may be that those all happen on a small handful of chains. It may be that there are separate chains for both. But we really need to think about those, how do we create interoperable standards that allow banks to make trusted payments across the different platforms?
And Rob, I would assume that just like today, you can set different controls around wire size and those sorts of things. Financial institution can set their own sort of limits to minimize any sort of exposure in terms of someone, transferring out $20 million or whatever. That can be done today, right? And probably
Yes.
done even better because it's programmable.
Yeah, absolutely. Each institution has full ability to set those controls internally.
Good question, Prakash. Other questions? We've got about 5 minutes left. Prakash, did you have one?
No, you called on me, so I know, thanks. That's helpful.
So Rob, for folks who want to contact you, I put up there on the, in the chat, your contact link. This has been really phenomenal conversation. Looking forward to seeing how this progresses. Would love to see some credit unions being part of your network as well. I hope you can grow it. I see a lot of benefits of it. I think, one thing banks and credit unions you have to think about and maybe scared about is that operating 24/7, 365. That doesn't mean that you have to be up 24/7, 365. And in fact, financial institutions already do that today to some degree, right? Because you've got ATM networks that are operating 24/7, 365. There are things that you have to think about that are a little bit different, but don't let that scare you away. And that's the way the world is going, the direction the world is going. So I'd encourage everyone to look into this, think about these use cases, think about signing up to the consortium and getting some benefit from it, because the network effects are important with this type of a solution. And Rob, really excited about your product and appreciate you sharing it with us today.
Yeah, well, Larry, really appreciate the opportunity to join you. I think the point you made there is so critical, right? There's a lot that's new here, and there are a lot of institutions that aren't going to be ready to deploy this tomorrow, right? There are folks that want to watch this take place in the market. But unlike things like Zelle, where you might get offered after the fact, I think it's really important to start understanding this and thinking about how it fits into your institution and your institution's future. That's one of the reasons why we thought that membership model was so important. We wanted to have a venue for folks to have a seat at the table, watch the development, because particularly with the regulatory scrutiny being applied to anything that looks like crypto today, even if it has no connectivity to that crypto ecosystem, this is just underlying infrastructure. Each institution is going to have to develop a level of, or demonstrate a level of sophistication with the technology that can't be built overnight. And so I think this is a really important area to keep a finger on the pulse and make sure you're watching, particularly what the largest institutions are doing here.
And Rob, to that point, do you offer any sort of onboarding for institutions that are going to be getting those requests for letters of non-objection that they have to file with the FDIC, or any, do you help out with that to some degree?
We do. At the end of the day, each institution needs to pursue its own non-objection, have their own conversations with their EIC. But we do a lot of work to make sure there's consistency, that there's full understanding as institutions move forward. And so we've got a ton of resources on the legal side as well around how to navigate some of that, what those approvals look like, and where the process stands today.
And for anyone else, we're always available, SRM, to help fill roles too. So that's my little sales plug. But with that, Rob, again, thank you so much. I appreciate everyone joining in. We'll share the video, and everyone have a great long weekend.
Thanks, Larry.
Thanks, Larry.
Appreciate that.